fact, one emerging market ETF just hitting an all-time high, and that's going back more than 20 years. Now, this one ETF getting a big pop from the pop in Taiwan semiconductor. But let's be clear, it is not just one market or stock powering these returns. It is truly global. Taiwan, South Korea, Indonesia, and others, all at or near record highs. The question, though, is where to now? Joining us now, Pramol Dhawan. He leads the emerging markets portfolio management at PIMCO and joins us now. Pramol, we talked about at the very top of the show with a different guest, Oh-Sung Kwon. He thinks the U.S. dollar, the debasement in the U.S. dollar, currency moves have a lot to do with this. What say you?
Yeah, we think we're early innings, Brian, in this emerging markets rally. This is not the EM rally of the early 2000s when you had a commodity super cycle and China came into the WTO. We really think this is a very durable rally built on solid fundamentals. Firstly, the ratings are improving for emerging market credits. Last year was the highest year ever. When you look at the ratio of upgrades to downgrades in emerging markets, it's the highest year on record. So EMs are being rated higher. The ratings agencies are saying that the underlying credit strength of these economies are doing better. That's thanks in part to really orthodox monetary and fiscal frameworks. Indeed, at a time when the same can't be said for the developed markets, which are going the other way in terms of their monetary and fiscal framework. So the fundamentals look very solid.
Yeah.
This is an under-owned asset class, Brian. I mean, we've spoken about this for many years. People have shied away from EM. They've favored U.S. assets. You know, U.S. assets comprised 65 to 70% of global portfolio allocations. EM is a fraction of that. And really, there's a lot of room within that sort of dollar debasement story for EM to catch up.
Yeah.
And then the final kicker, Brian, just on valuations. You know, in a world where credit is rich, where equities are at an all-time high in the U.S., where rates are range-bound, you know, emerging market offers investors value, whether it's bonds, real yields offering 8 to 9% across Brazil and Colombia, whether it's equities that trade at a 40% discount to U.S. equities. You mentioned Korea and Taiwan here. We see a world of opportunities and values across emerging markets.
Your data shows wild underinvestment, under-allocation to this group. Your fund rose 22% last year, largely investing in government bonds. Congratulations on that. So why aren't more investors allocated to it? Is it because, like, you know, you just buy NVIDIA and make a bunch of money and go away?
Look, I think people have been quite gun-shy around emerging markets for the past 2 decades. Or put it another way, EM was really the biggest casualty in an American exceptional environment. So when the dollar went up, when U.S. equities just kept going up in a very linear fashion, as you said, there was no need to do anything else. You could have just bought the U.S. and gotten away with it. But, you know, last year that wasn't the case. You know, Korean equities were up sort of 70, 80%. EM equities broad-based up 40 to 50%. Whether it's bonds or equities, global assets outperform the U.S. And we think we're at the early innings in a multi-year cycle where global diversification, where emerging market assets are going to outperform. And you really do need to think about how to diversify your portfolio.
Quickly then, where in the world are you looking?
So we like in fixed income, we like Latin America, high real yields, good starting valuations within the U.S. sphere of influence. That mitigates a lot of left tail risk like we saw in Argentina. Within equities, I think you focus on Asia. China equities, China's pivoting towards more of a consumption-based economy. That's going to boost equity markets domestically. We also like Korean equities and Japanese equities.